Imagine waking up tomorrow and realizing your government doesn't actually control its own money. Not in a conspiracy theory way, not secretly, but openly, legally, and by design. That day already happened. Most people just didn't notice because money didn't disappear. It changed owners, and the consequences are still unfolding. Right now, this matters more than ever. Inflation feels personal. Debt feels permanent. And every policy announcement sounds powerful, yet somehow ineffective. So, how do we get here? Let's start with something simple. For most of modern history, money was a political tool. Kings minted coins. States printed notes. Governments decided how much money existed and what it was worth. If they overspent, the currency collapsed. If they underfunded wars or infrastructure, they lost power. Money and sovereignty were inseparable. Then the 20th century broke that link. After World War II, governments made a deal with themselves. They wanted economic growth without political instability, spending without visible taxation, power without blame. The solution was elegant and dangerous. They outsourced money. Central banks were given independence. At first, this sounded responsible. Experts, not politicians, would manage currency. No more reckless printing. No more short-term election games. But independence didn't mean isolation, because governments still needed money. So instead of creating it directly, they borrowed it. Here's where the system quietly flipped. When a government spends today, it rarely uses money it already has. It issues debt, bonds, promises. Those bonds are bought by banks, funds, pension systems, and global investors. And the money used to buy them is created by the financial system itself, not by parliaments, not by voters, by balance sheets. This is the uncomfortable part. Most money in modern economies is not printed by governments. It's created when banks issue loans, mortgages, corporate credit, sovereign debt. Every loan creates money. Every repayment destroys it, which means money now lives and dies based on credit decisions, not democratic ones. Governments became the largest borrowers in a system they no longer fully control. At first, this worked beautifully. Debt fueled growth. Growth stabilized politics. Everyone got used to it, until the math started getting weird. Debt compounds. Politics doesn't. To keep economies stable, governments needed low interest rates. To keep debt affordable, they needed constant refinancing. To keep markets calm, they needed confidence. So central banks stepped in again. They didn't just set rates. They started buying the debt. Quantitative easing. A technical term for a simple idea. If the market can't absorb government debt, the central bank will. Trillions were created. Quietly, digitally, legally. And this is the moment money truly changed hands. Because once markets expect central banks to support debt, governments stop being issuers and start being dependents. They can't allow rates to rise too much. They can't let bond markets panic. They can't meaningfully reduce debt without risking collapse. Policy becomes reactive, not strategic. Here's the irony. On paper, governments still control money. In reality, they manage expectations. Markets decide what's acceptable. Investors decide what's risky. Credit decides what's possible. And the public narrative stays comforting. Inflation is temporary. Debt is manageable. Growth will fix it. But underneath, incentives tell a different story. The system rewards borrowing, not saving. Asset inflation, not wages. Stability for capital, volatility for households. When money doesn't belong to governments, it doesn't belong to citizens either. It belongs to whoever can access credit cheapest. That's why asset prices explode while living costs creep up. Why crises are met with liquidity, not reform. Why emergency policies never fully reverse. Zoom out far enough, and the risk becomes obvious. A system where money exists mainly as debt cannot shrink gently. It either grows or breaks. And the longer it grows, the less control any single institution actually has. Not governments, not central banks, not voters. So here's the question worth sitting with. If money no longer belongs to governments, and governments no longer fully answer to citizens, Who exactly is the system optimized for now? And what happens when confidence, the one thing holding it together, finally runs out